Two American service members are dead after Iranian missiles slammed into an airbase in Jordan. The president answered by declaring in his words that the gates of hell are open. And yet, the S&P 500 fund, SPY, closed Friday at 743, spitting distance from all-time highs. That gap between the headlines and the tape is today's entire story. And there are exactly two prices on SPY that decide which side wins. The levels, the setups, and a $7,500,000 options bet are all on the desk today. So let's get to work.
The headline itself, because it deserves to be read plainly. NBC News: U.S. and Iran trade strikes after two U.S. service members killed in Jordan. CENTCOM confirmed the troops died defending against a ballistic missile and drone barrage at the Muwafaq Salti Air Base. 4 more were wounded and evacuated to hospitals. 1 service member is still listed as missing, and the American death toll has now reached 16 since this conflict ignited in late February. The retaliation came within a day. Reporting describes an 8th consecutive night of strikes on Iran, aimed squarely at the units that fired on the base and at Tehran's ability to threaten shipping in the Strait of Hormuz. Here is the part that should make every trader sit up straighter. Quoted in the reporting, suspect Iran may be getting targeting help from China or Russia because Tehran's missiles have been finding sensitive sites with a precision they had not shown before. Fast, maneuvering warheads designed to slip through layered defenses. If a regional war quietly becomes a great power proxy contest, the risk premium on every asset class gets rewritten. Iran's leadership answered the weekend's strikes by calling the president's signature worthless, warning of unforgettable lessons, and declaring the interim deal finished. Germany and Britain are pulling diplomats out of Qatar, Kuwait, Bahrain, and Saudi Arabia, a spread of withdrawals that says the threat is regional now, not local. The State Department issued a worldwide caution for Americans abroad. And the target lists on both sides have widened well past military sites. Bridges, ports, and utilities on one side, power stations and desalination plants on the other. This is what escalation looks like when neither side wants to blink first. Oil noticed all of it. Crude just printed its strongest week since April, helped along by reports that dozens of additional refueling aircraft are being sent to the region ahead of a possible larger offensive. There was one genuinely constructive headline in the pile. Baghdad and Damascus inked a deal to revive an old crude pipeline, a route that would move barrels westward while skipping the Strait of Hormuz entirely. If that project actually comes to life, it is one of the few pressure release valves on the whole board. File it away and watch for follow-through. The war is not even the only tape mover this week, because there is a brand new tariff fight. Canada is guilty of what he called willful negligence over wildfire smoke drifting south into American cities, and said the cost of that pollution will be added to Canada's tariffs. The Hill's headline: Trump says Canada will face tariffs over wildfire smoke, claiming willful negligence. Canada is one of America's largest trading partners. More than a dozen states are sitting under air quality alerts, and Ontario's premier has already called the threat unacceptable. Unacceptable. We have all watched tariff shocks ripple through autos, materials, and industrials before. This is a fresh overhang landing on a market that already has plenty. And speaking of ripple effects, the chip complex took the hit last week. The semiconductor ETF, SMH, dropped almost 9% by the analysis we tracked, its third down week in 4. The deeper reason sits behind a challenger out of Beijing. Moonshot AI released Kimi K3, which the company describes as the largest open-weight model ever published. 2.8 trillion parameters, a 1 million token context window, and free for anyone to download starting July 27. The claim that stings Wall Street is simple: performance rivaling the top American systems at a fraction of the price. Under the headline, Markets experience new DeepSeek shock after Moonshot AI releases Kimi K3. The reported damage?
NASDAQ down about 1.5% on release day. NVIDIA off 2.2%. Applied Materials down 5.6%. And the Philadelphia Semiconductor Index down 12.5% for the week. Its worst week in over 15 months. When open models get cheap and good at the same time, the market reprices who actually captures the AI profit pool. And that question lands directly on this week's calendar because Tesla, Alphabet, and Intel all report earnings, with a wave of other names stacked behind them. The economic calendar itself is light. Weekly jobless claims Thursday, new home sales Friday, so earnings and missiles will do the driving. Keep an eye on QQQ at 695 and the 10-year yield at 4.54 while it plays out. Growth stocks are fighting a two-front war of their own. Now the cracks in the foundation. Roughly 228,000 American homes caught a foreclosure filing in the first half of 2026, up 21% from a year earlier and back near levels last seen before the pandemic. CBS News wrote it up as foreclosure filings surged 21% this year. Here are the states where they are rising fastest. Florida now carries the worst foreclosure rate in the country, with South Carolina right behind it. And the states leading the surge tell you this is spreading, not concentrated. Idaho posted the sharpest jump of all, up 59% year over year. Colorado shows the Mountain West is next, up 57%. Georgia says the Southeast follows, up 52%, and North Carolina is rounding out the list at 47%. To be clear, these totals are still below every pre-pandemic year from 2008 through 2019, but the direction is wrong, and the housing stress is real. The analysis we tracked also flags a labor market claim. 105.8 million Americans now sitting outside the labor force entirely. An all-time high in raw numbers, and by their math, the largest share of the adult population since the 1970s, outside the pandemic. We could not independently verify that one, so treat it as their figure. But foreclosures rising, labor participation sagging, and a shooting war overseas is not a backdrop that rewards complacency. So let's pull up the desk chart and talk about the only two prices that matter on SPY right now. Last week, SPY finally resolved the big weekly range it had been stuck inside, and it resolved down. The market gapped lower early, bounced back up into the underside of the broken range, got rejected there, and rolled over again. That rejection zone is the ceiling the bulls lost, 747 to 748. Reclaim it, and the whole breakdown was a fake out. That would be a genuinely bullish tell. Below us sits the floor everyone is watching, 739 to 740, a shelf that has been tested again and again over recent weeks. SPY closed Friday at 743, almost dead center between those two numbers. That is the battlefield. If 739 caves, the trapdoor underneath opens towards 727.50, the recent swing low and the first serious downside test. And there is one more air pocket from late June sitting far below near 717. It is a long way down from here, but wars have a habit of making faraway levels arrive early. Zoom out to the weekly, and the seasonal picture cuts both ways. The studies cited in the analysis say July during a second-term midterm year is historically the single weakest month on the calendar, green less than half the time, while the fourth quarter in those same years has been remarkably strong, with October and November green in every instance of their sample, and average full-year gains near 20%. Seasonality is a tailwind chart, not a trading system, but its message is coherent with the tape. Rough summer, better autumn. Position sizing is how you survive the first half of that sentence to enjoy the second. Time for setups. And a reminder before we start, everything here is levels to watch, never instructions. Our first setup on deck is APA Corp, an upstream producer, pure oil and gas exploration and extraction, which is exactly the profile that catches a bid when crude rips. The stock has spent months compressing inside a big falling wedge on the daily chart. Buyers keep defending this base around 32, with bounce after bounce off that zone. bounce off that zone. Now price is pressing against the shelf at 35 to 35.50, right where the wedge's downtrend line comes in. A strong open for oil this week could snap that trend line, and if the shelf breaks, there is room to run higher. 38.50 stands out as the first meaningful resistance above, and the analysis argues a genuine oil spike could carry the move well beyond it. On the other side of the tape, the memory trade is unraveling. DRAM, the memory chip fund, fell roughly 16% last week by the analysis we tracked, and it keeps leaning on its recent lows. The zone that matters is 49 to 50. If sellers press price down through there, the downside likely is not finished. Fair warning on this whole group. Memory names have been some of the most violent movers in the entire market, ripping higher for a day before dropping all over again. If that kind of whipsaw does not fit your temperament, this is a chart to watch, not to touch. Meanwhile, the fear gauge is stirring. The VIX has spent weeks coiled off its floor around 15, bouncing off that shelf repeatedly, and it sits near 18.8 as we speak, already off the mat. The prior spike topped out around 23.3, and a pushback toward the recent peak, or through it, is exactly what this news cycle could produce. The analysis pairs that view with volatility-linked products like UVXY and with SPXS, a 3x inverse S&P vehicle that rises when SPY falls. It gained about 3% Friday. Understand what those instruments actually are before you ever go near them. They decay over time, they are engineered for days and weeks rather than months, and they carry sharp edges. Levels to watch, nothing more. And energy keeps grinding higher while everything else wobbles. XLE, the broad energy sector fund, has been stair-stepping upward and holding its support cleanly. Refiners have been the standouts. Their margins fatten as gasoline prices climb, and natural gas-linked names have joined the party. The longer the Middle East burns, the longer that relative strength likely persists. It is the one corner of this market where the war is a tailwind instead of a threat. Quick momentum radar, with all triggers attributed to the analysis we tracked. LMD rose about 4% Friday, and a push through 67.50 is the continuation trigger there. Lucid Motors has gone wild on bankruptcy rumors the company itself denies. Clearing last week's spike high is the line that matters. AFRM took a beating Friday. A break below 75 puts downside continuation in play. 3 names, 3 triggers, 0 obligations. Which brings us to the big money trade. Someone spent $7,500,000 on McDonald's call options Friday. The 280 strike expiring June 17 of 2027. The context is what makes it interesting. McDonald's is working through its deepest percentage drawdown since the 2020 crash, yet the long-term weekly chart shows a rising channel that is held for years, and price is now testing the channel's lower boundary for the 3rd major time. The logic writes itself. If the channel floor holds near 260, the downside is defined and tight. And if the stock repairs itself over the next 8 to 12 months, the path runs into the full recovery zone near 300 and beyond, which pushes the reward to risk north of 3 to 1. Layer on 50 straight years of dividend increases and the classic rotation into stable, cash-generating names during uncertain markets, and you can see exactly what this buyer sees. This is long-dated, patient capital, the polar opposite of a panic trade. And the last time the stock tagged this channel floor, the recovery took months, not years. So here is the desk summary. The war headlines are getting worse, not better, and the market has stopped fully ignoring them. SPY at 743 is pinned between the ceiling it lost at 747 to 748 and the shelf at 739 to 740. Whichever breaks first probably writes the next 2 weeks of tape. Oil and energy carry the momentum. Semiconductors carry the wound. Volatility at 18.8 is the coiled spring. And this week's earnings put Tesla, Alphabet, and Intel directly into the crossfire. Watch the levels, respect the tape, and let price confirm before conviction. If this desk brief saves you even one bad decision this week,
The subscribe button is right there. One tap, and tomorrow's levels find you automatically. Nothing in this video is financial advice. It is analysis and levels for educational purposes only. And every decision in your account is yours alone. Trade carefully out there. This is a market that punishes autopilot. See you tomorrow.